On to our first conversation, Nigeria's federal government is seeking to borrow 2.5 trillion naira from its second FGN bond auction of 2024. That's this month. And that's according to the latest circular from the Debt Management Office. According to the circular, the auction is set for February 19 with a settlement date of February 21 this year. Now, both bonds are newly created papers. It's a February 2031 7-year bond worth 1.25 trillion naira and a February 2034 10-year paper worth 1.25 trillion naira. Now, in the previous month, the DMO offered 4 bonds worth 90 billion naira each. Vincent Oshoma, Head Capital Markets Interstate Securities, joins me for more on this. Vincent, thank you for taking the time out to join us today.
Thanks for having me. Good morning.
Just to get your initial thoughts, so what do you think about this plan by the federal government to borrow over 2 trillion through this bond auction?
It's quite huge when you look at the amount offered in the previous auction. It's quite short in terms of the amount, but it's not so surprising when you look at it's still within the government plan for the year and also current liquidity. I think the government is trying to take advantage of current liquidity in the system. We remember that the last Treasury bill auction, it was oversubscribed by about 300%, despite the huge surge in terms of the rates. The 1-year Treasury bill was 19%. Also, and the government, the subscription at the end of about 1 trillion, but we had about 2 trillion in terms of the subscription, total subscription. So I think the government is trying to take advantage of current situation in trying to mop up liquidity in the system.
Now, just thinking about yesterday's trading at the bond market, the secondary bond market, yields are averaging around 15.8%. That's on the short end of the curve. But what are your expectations on subscription levels and stop rates for this particular auction that we're going to see in February?
If we are judging by the last auction, we expect, because we have seen increase in rates and also considering the fact that the inflation figures becoming out today, so we expect that to determine to have an impact in terms of the rate. So we expect the rates for the auction to be quite high. And I think from the trading yesterday, a lot of persons are looking forward to that auction in terms of determining rates. So traders are looking forward to what will happen on Monday. And it's expected that it's going to be higher than what was the previous rate in last month's auction.
Now, obviously, this is a reflection of the government's plan to borrow more, at least compared to what it borrowed last year to fund the budget deficit. But this also has implications for debt servicing. But what are your thoughts in terms of, how the government tries to balance, debt servicing vis-a-vis its revenue targets or projections for the 2024 budget?
Yes, it's quite a concern because as much as this, the amount is within government's plan, but when you look at debt profile, it keeps increasing, especially when you look at the devaluation of the currency. The last figure that came out for third quarter last year, I think about 87 trillion. I think it's expected that the next report by DMO should be about 100 and something trillion, which is which further worsens our ability to service those debts. So it's quite a concern. But when you look at the tight situation the government is facing, I think the government is resorting to borrowing because which is what was common in the previous administration. But unlike the previous administration, I think this government is focusing more on the regular borrowing rather than resorting to the ways and means. I think that's one of the things they use to fund their budget. So revenue continues to be an issue to the current government, and they'll continue to look for ways to increase. And one common way they resort to is revenue, and it has an impact on the system, both crowding out the private sector and also the affecting ability of investors and businesses to borrow, because the government rate to determine the borrowing rates of other people in the system.
Yeah, that was going to be my next question. What this means for corporates, that whole crowding out effect that we continue to see at the market, because the government, of course, the bulk of the borrowing stock for the federal government is a domestic bond or domestic debt. Now, but many corporates did turn to commercial papers in 2023 to raise cash to fund their operations. Do you see this gaining more momentum in 2024? And I know that, of course, the rates usually benchmark the FGN rates. What kind of rates also can they look forward to?
Yes, we expect to see more of a lot of commercial papers this year because, you know, as the cost of borrowing it keeps increasing, the corporates will keep looking for ways to reduce their cost of borrowing. Definitely, once there's an increase in government rate, definitely it has an impact because the risk level will also increase. There will be corporates you are expected to pay a risk premium compared to government rate. So expect to see an uptick in their own rate. But I don't think it will actually reduce the borrowing because a lot of those corporates, when you look at their loans to finance their existing debt, they will have to look for ways to finance it at cheaper rates because the rate generally is going up. So they will still have to resort to things like CPs to get money. Yes.
Another part of this conversation is also, and this is on the Treasury bill side, that auction we saw, I believe it was last week, where we saw the one-year paper going for as high as 19%. Now that obviously is a deliberate attempt by the authorities, the fiscal authorities, or the CBN rather, to attract more foreign portfolio investors into the country, obviously to boost the FX reserves also. Is this a very delicate balancing act for both the fiscal and particularly the monetary authorities?
Yes, I think, like you mentioned, that was a deliberate attempt by the CBN in terms of attracting that, because we definitely need FPIs in the system with the forex challenges. And if you look at some of the moves, what has happened in respect to the rates, trying to achieve convergence between the official rate and the primary market rate, these are different moves. And I think those moves will start attracting FPIs. There are pillars that FPIs have started coming into the system, and we expect to, as we continue to see stability, once the relative stability in the forex market is achieved, I think we start seeing them coming in, which is what the CBN and the fiscal authorities are targeting in terms of stabilizing the forex. I think that's the way they want to go. It's a deliberate act, and it also boils down to one thing, which is what we have always looked forward to, and understanding a close relationship between the fiscal and the monetary policy managers, which was absent in the previous administration. And currently, we are seeing that a close working relationship between the fiscal policy authorities and the monetary, which is good for the system.
Right, you're absolutely right on that one. Let's, as we round up, just quickly broaden this conversation. There are ongoing conversations, as you know, on the debt levels, rising debt levels across sub-Saharan Africa. Nigeria is also a classical example. Now, some of the conversations I've had with some market analysts is that one of the reasons why we see many countries on the continent having huge debt stock, especially on the foreign debt side, is because they have very underdeveloped and shallow capital markets that are unable to meet funding needs, especially for the fiscal authorities. But when you think about the Nigerian capital market and how it's been able to serve the needs of the fiscal authorities in the area of raising funds to fund the budget deficit, how would you assess the depth of our market?
Yes, you're right in terms of the market has been able to meet the needs of the government in terms of borrowing, which is good. But when you look at our market, there's a lot have been done in terms of the debt side of the market, but a lot still needs to be done in terms of the equity side. When you look at the size of our market relative to our GDP, compared to the South African market and the GDP, so a lot still needs to be done in terms of deepening our market and developing our market. But a lot has been achieved, especially with respect to where we are coming from with the debt market, but still much needs to be done.
Right, so Vincent, we'll leave it there. Thank you so much for talking to us today. We appreciate your time on the show.